Join us now. Looks like he swallowed a canary. Counselor to the Treasury Secretary, Joe Lavorgna. You might actually know things instead of just being conjecturing. What you heard this discussion?
Yeah, I mean, there are four great candidates. I mean, the street is very familiar with all four, and they'd all be very good. And I think Steve is exactly correct. The Secretary has done a very thorough process and is going to give the president that list. He's given the president the list, and it's the president's decision at this point as to who he wants. And whoever is ultimately chosen, I think, will be very effective.
You're going to walk this. You're not going to give any give us any idea how you feel. Let me ask you about Warsh, because in the past, I think some of the credibility that he's built up on Wall Street has been, I guess, the perception that if he had to raise rates, he would raise rates like crazy. And I think he's been critical of the Fed and the recent policy moves and really how powerful the Fed has become, how transparent the Fed has decided to be. Thinks that's bad. How did he get back in the good graces of President Trump?
Well, some of that stuff, Joe, is from a long time ago. And I think really in any of these instances, if the Fed needs to raise rates, they'll look at it holistically. The president wants somebody that's going to be sort of objective and look at this potential productivity boom based on his policies. You've got these supply side
and AI
policies. Part of it's AI, but also, no tax, rather full expensing for capital expenditures. Now it's permanent, 100% expensing for factories. That's going to create a supply side boom. We're already seeing it in the GDP data. We're going to see it more evidently next year. And the president wants somebody who's going to look at this holistically. And the secretary has given a lot of candidates, so I think objectively we'll look at the current situation as is, including Kevin Warsh.
Well, let's talk about the current situation. So you probably think rates could go lower, but at the same time, you probably think the economy is ready to take off.
I think the economy is very healthy.
You think it's 5% next year, like we're hearing?
Larry mentioned 5%. Look,
Carolyn Levitt.
I said to Steve earlier, if you look at the non-financial corporate productivity growth in the last 4 quarters, it's up 3.5%.
Yeah.
I mean, certainly we could have a real big boom next year, but you do need lower rates, so to speak, to grease the skids of more investment spending, especially in infrastructure as it relates to building factories and such.
But you don't think it would run too hot?
I don't think it'll run too hot. No, I mean, if you look at inflation expectations, Joe, they're very stable. The yield curve is flat. President Trump was correct. Secretary Bessent is correct. The tariffs have not had the effect people thought they would. I've made that case myself. And, you need interest-sensitive activity to be stronger. There are pockets of the economy that are soft. And that's reflective of rates needing to come down. And inflation's a lagging indicator. So as you build productive capacity and you invest in CapEx, which is inherently disinflationary, you could have much lower rates and the economy reaches its full potential.
The Journal wrote a piece, where are the manufacturing jobs? And in fact, and this is in keeping with what they've been saying since day one about tariffs. They're saying the willy-nilly tariff assignment is causing companies they're not laying off people, but they're not hiring people because they're not sure what the future looks like, what the Supreme Court does, what happens with tariffs. Do you blame manufacturing jobs have fallen?
So let me just say, but Joe, if you look at the CapEx trend, in the first half of the year, CapEx grew nearly 15% in real terms. Ex the pandemic, that's the biggest increase since 2011, 2012. CapEx leads the hiring cycle.
So you think
and with that will be manufacturing jobs. I do think it's coming. Now, what's interesting, and this is important, in the one big beautiful bill that the president got through in record time, that bill, 100% expensing for factories. The normal shelf life of a factory expenditure is nearly 40 years. You're going to be able to expense it fully in year 1, and it's only going to go through 2028. The IRS is just finally putting the finishing touches on the guidelines for that. So next year should see a huge factory boom, and all the equipment that goes in it will also be 100% expensed. So it takes a little bit of time for those manufacturing jobs to start to become more evident. And again, lower rates will also help, similar to the point the president made back in 2018 when he said, look, rates are too high, the Fed needs to cut. We saw the ISM survey soft, and then, of course, in 2019 you had a boom. The economy grew nearly 3.5%.
When we were watching the Biden economy, and people were saying, well, Americans just don't understand how great it is. And the media was singing that tune. I always pointed to the notion that real wages fell. That's why people...
Yeah, they were down about 4/10 annualized over the 4 years.
There's a reason
they were negative.
There's a reason people felt like crap because of that. explain now why you're hearing so much about affordability when wages are rising faster than inflation.
So part of it is I do think the rate story, because you look at first-time affordability fell to a record low under the prior administration. Rates at this point are a big driver of why affordability for homes is low. In other words, you need to get rates down. But what's happening, Joe, and again, this comes to the forward, is if you look at the bill as it's written, no tax on tips and overtime, that is going to further lead to huge increases in real after-tax income. And by the way, if you look at the blue-collar workers, through November of this year, we are up 1.6% annualized. That is one of the biggest increases we've had in the last 60 years to start a new administration. So there are a lot of good things happening. Earlier, you mentioned oil prices or gas prices being low. I mean, it's going to take some time, but the president clearly has put in place policies that benefit middle and lower income workers. We saw it in the first administration. The markets are reflective, I think, of a boom next year. You're seeing very tight credit spreads. You're seeing the bond market perform very well, the best performing market in the industrial world so far this year. And you're seeing the equity market perform well. I mean, that's just confidence in the policies. We've just got to give it a little bit more time for everything to take hold.
Right, because I can give you a list. I mean, people point to 4.6% unemployment is the highest. That's still full employment.
Well, no, and you've got
that's basically full employment.
What's very low, Joe, and what's important is you've got rising participation, and a lot of the jobs are
2.7 on inflation, new highs in the stock market. I mean, it's not an economy where people should be saying, I'm miserable.
No, but the president really, though, is focused on working class Americans, middle and lower tax workers, middle and lower income workers, and this is why they'll get substantial refunds next year. Gasoline prices should go lower. That's money in people's pockets. As rates come down, affordability goes up. I mean, this is really, it's breadth and depth of the president's policies that matter most.
Do you think we're going to grow out of the deficit? Is that your idea?
Joe, if we don't have growth, we're going to have nothing.
Should we raise taxes on the rich?
We need to have taxes in place that allow us to spend and create the economy that we want. The revenue share of GDP is over 17%. The problem has been on the spending side, and the spending numbers have slowed both in fiscal year and calendar year since the president took office.
Right. I think Andrew wants it.
Hey, Joe, just on the tax front, I don't know if you saw that. We were talking about this Mitt Romney piece, not just about carried interest, but really at death. Stepped up basis to death. He says it's got to go away. You can't do it this way. There's too much money that's being effectively lost in the system and creates too many perverse incentives where too many people of great wealth are able to effectively live off of loans their entire life for the rest of their life, so that they don't pay those taxes. Where do you stand on that? And at least from my vantage point, I don't think that would actually change the growth story.
Well, Andrew, again, as I was saying to Joe, I mean, we really have we don't have a revenue problem. Revenues are actually very robust at over 17% of GDP. It's really on the spending side. If the economy, though, however, grows, Andrew, if we grow at 3%, which to me is very doable given the productivity trend and what we're starting to see on the labor market recovering, even at a 17% revenue share of GDP, we're going to raise about $4 trillion more money, I calculated some time ago, than what CBO was predicting, and that's a huge, huge benefit to the longer-term budget outlook. So on the tax side, I'm all for keeping taxes on labor and capital as low as possible to create the growth, to create the goods and services and industries and jobs that people want. And the other thing we have, Andrew, is the deregulation side is very powerful. This is going to get businesses growing and hiring and expanding. And it's just going to take some time, but we are seeing the labor trend improve the last few months. And all the guideposts for 26 should suggest it should be a boom, as Secretary Bessent said.
5%?
I would love 5%. 5% would be great.
I'd love 10%. I'd love. Yeah.
If you look at the street, there's many private sector forecasts, some very good private sector forecasters saying 3% real GDP growth. To me, that is very, very doable. We saw it in the first administration.
We must have been making a lot of mistakes for the past 30 years because we've been unable to get out of the. And we've been doing better than the rest of most of the, like Europe.
Well, a lot of the debt, though, Joe, was in the last administration. We had a huge increase in the debt.
And not great in the first Trump administration either.
No, but we were growing almost 3% in the first 3 years. We were 3.5%.
I mean, the debt, we did do a little bit too much deficit spending, obviously. Right?
Well, not really, because if you look at the numbers, the TICJA, the Tax Cuts and Jobs Act, effectively paid for itself if you look at what the CBO scored out and what happened.
Right.
On the revenue side. And again, the spending, as I said earlier, is a bigger issue. But these things have been in the making for a while. President Trump's done a very good job. And at this point, the deficit numbers have looked a lot better, Joe. We're 1.77 trillion last year. Yeah, so, I mean, it's going to take time. But we're moving in the right direction.